Welcome to the Unbiased Advisor Podcast, where we explore investment themes and insights for investors and financial advisors alike. The views expressed are intended solely for informational purposes and should not be construed as investment advice and are not meant to be a solicitation or recommendation to buy, sell, or hold any securities mentioned. Please stay tuned for additional disclosures at the end of the podcast. Today on episode 2, recorded on December 10th, 2020, we have David Burns, PhD, of Simplify ETFs and author of Modern Asset Allocation for Wealth Management. We will discuss his book and in particular how investor biases impact portfolio construction. I hope you enjoy our discussion with David Burns. All right, David. Welcome and thanks for joining us today. How's the weather out there in New York?
It's getting cold, man. It's getting cold. We had our first little snowflakes yesterday, and my 2-year-old loved it. And but yeah, it's the cold's here.
Yeah, I think there's a storm coming that I saw this morning headed up towards you guys, right?
I haven't even looked at the weather. I have no idea.
That's all right. All right. Well, again, thanks for joining us today. I want to kind of get into your book, but before we get into the book and your software package, could you just give us a little history about your background, where you came from, what you've done up to this point?
Sure. Yeah. So I mean, I started my career as a physicist. Was working in building some of the first quantum computers, really doing the fundamental research in that space. And I love physics, still do, but I found it to be a bit isolating. You just sort of work with your research team, and you don't really connect with the outside world. And so yeah, I kind of found my way to finance. I mean, when I was leaving MIT, about 45% of the entire MIT graduating class, undergrad and grad, was going to Wall Street. This is in the middle of the 2000s.
From the physics department?
From everywhere, across all departments, 45%. So we were just, Wall Street was just bleeding dry, all of our smart research, talent. I think that number is like 4% now.
Huh.
So totally different landscape in that regard of where that research talent is going. But yeah, so I took a bunch of classes at Sloan while I was there, finishing my PhD, and I really fell in love with finance and more mathematical finance. The cool thing at the time for me was that in physics, you always focus on what we call closed systems, which are basically you sort of study things and ideas in a bubble, finance was like the ultimate open system, right? Like human beings and all noise possible is just constantly affecting the system you're studying, and they're a big part of the system.
Right.
And I thought that was just so different and exciting and just up the challenge. And that was one of the major things that got me into it. And then I just also fell in love with the asset allocation problem. I mean, the whole world deals with asset allocation. Everyone's going to retire. Everyone, should be focused on how to retire, and how to build portfolios and save and grow wealth and stuff. So I just was so excited to work on a problem that impacted everyone.
So how did you step into the finance side of things then? Did you get an internship or
Yeah, I went and started to work at this really awesome firm called Athena Capital Advisors. Wealth management firm outside of Boston, founded and run by Lizette Cooper, who was a former scientist from Harvard, who transitioned into like the quant finance and asset allocation and wealth management space. So we resonated immediately, and she took a gamble on me bringing me on to really work the asset allocation and risk management models. And help systematize. And I spent 7 or 8 years there. And yeah, I've loved that, solving that problem ever since. And that was one of the things that really got me to write the book, because after going through that process and starting my career from science into that seat at Athena, I focused on building a system that was accepted by academia, and was the common methodologies put out there: Black-Litterman model, strategic versus tactical asset allocation. And then we were doing like a real endowment style of investing. because the average client size there was over $100 million. And so we did liquids, we did illiquid. And
At Athene, you're saying, correct?
at Athena, yeah,
Yeah.
yeah,
Okay.
that's right.
Yep.
So yeah, but going through that process, maybe 3-4 years ago, I just looked back at it and said, how did we get there? How did that process even get there? Is there something more that we can do? And so I was kind of ready to take a step back and say, what does asset allocation look like today, right? Modern portfolio theory was discovered in 1952.
Yep.
A lot has happened. And so yeah, so recently I got to take that step back and really ask that question: why do we build portfolios the way we do? And is the status quo there? Is that the right move?
Yeah. So yeah, I'm not quite sure exactly how I actually stumbled onto your book. I think I might have heard it in passing on another podcast or something like that. But this is it, right? Modern asset allocation for wealth
That's it.
management. Um,
That's it.
it's
Props to Wiley. Props to Wiley for letting me do it.
So did they approach you about doing it, or did you approach them, or did you write
No,
the script, so to say, and try and shop it around?
yeah,
how'd
no,
that all mesh out?
I approached Wiley, got one of their executive editors, contact information from a friend of mine, and once I had the book idea in place and I had an outline for it, I pitched them and took a little hustling, but eventually got the deal. Yeah.
Well, I'm personally glad you did, because it does put a light and a framework onto our field in the asset management, wealth management field, on a different approach to the asset management, how to build portfolios, right? In fact, right out of the gate in your book, you say, Homo economics,
Economicus.
economicus.
Yeah. That's a tough one.
I think Thaler has a different name for it. I can't. I think he just calls him Econo Man. Is the
Yeah,
way he
that's
phrases
probably
it,
a better
right?
one. Yeah,
Yeah.
yeah.
So the perfectly rational investor is no longer the client we're building portfolios for. These evolutions cannot be handled in the MPT framework, which is modern portfolio theory. Nonlinear assets cannot be representative by mean and variance, and the mean variance approach cannot capture the nuances of behavioral risk preferences. I read that and I thought, wow, this guy is really attacking, this foundational theory that a lot of advisors work off of, right? And I think it's a great lead into kind of the premise of the book, and how you kind of lay things out. Could you maybe first talk about the mean variance framework and where you kind of believe it falls short in its current iteration right now?
Yeah, let's do that. But first, let me just step back 1 second. So,
Yeah.
it's really helpful for listeners to understand that the book in its entirety, this is one of the important features you're talking about for sure. But the book in its entirety is really about how to build portfolios from a first principles approach systematically.
Okay.
So when I was at Athena, I got to really witness firsthand how challenging building a portfolio was, even for me as a quant, with estimation error and all, needing so many inputs, et cetera, that I got really excited about building an end-to-end process from
Yeah.
first principles for advisors, right? And what you're mentioning here on MPT is really one feature that gets questioned in this process. But I think we'll get to talk maybe in a bit about sort of some of the rest of it. But I guess let me just give a quick outline of what it looks like. I mean, from
Sure.
a systematic perspective, the first thing you want to do from a first principles perspective is say, how do you create a portfolio for a human being? Like, what does that even mean?
Yeah.
What is, hey, Mr. X, you should have 50% real estate in your portfolio. Why? Who are you? Like, how do you, that's a really, kind of like almost existential type of a question to me, like what does that even mean? So I think that's the first thing is you have to figure out a systematic approach to say, I have a human and I should give them a portfolio. So there's got to be some kind of profiling and balance sheet analysis. And so we'll dig more in on that, I think, in a second. But then the next thing is why do we have certain assets in our portfolio, right? There's a lot of portfolios out there, Harvard Endowment, that have 50 to 100 line items in their portfolio. So why? That's like a fundamental question. If you're going to solve things from first principles, why are those assets in there? The next really important thing is, how do you forecast the future, right? Because we're building portfolios for the future. So that's an overwhelmingly challenging problem if you don't simplify it and give yourself the right tools to do it. And then ultimately you have to optimize. So you have to build the optimal portfolio with all those inputs in it. And so I think there's really interesting, novel things in each part. But anyway, that's just a little high level color on sort of what some of the mission was.
Sure. So you actually, you do kind of, you start off from MPT and then kind of build up, I feel like, right? Like you show that there is this mean variance, which is what most advisors build a portfolio off of. And so can you kind of say how you do build off of that and go forward on that?
Yeah, I think the really powerful anecdote to understand about mean variance optimization is that it's a great and accurate system if one of two things happens. It's an or statement. If assets are very normally distributed, right? Or if an investor's preferences are not very asymmetric, right? So if they have very rational preferences and all they care about is volatility, which is a symmetric concept, then MPT will be fine.
Yep.
And so if you think about it, we've learned that people actually have a lot of asymmetric preferences. We learned that in the 1970s with prospect theory. So that approximation, that one's been failing. So then the big question is the other side of the or failing, which is, are the assets in the portfolios non-normally distributed? And the reality is that most investable assets, even today, still are quite normal.
Okay.
So from that perspective, that's, and there's been tons of studies on how much skew you have to introduce into an investable asset for the mean variance approximation to not be so accurate. And you need a surprising amount of asymmetry. So MPT, that's why it's been so successful and hasn't been challenged. But I just started an ETF company that's focused on convexity, and so you kind of know the reason why now, right? Yeah. If the other side of that, or if there's very asymmetric investable assets, and we know human preferences aren't symmetric, then all of a sudden that criteria fails, and monoportfolio theory isn't interesting, or is less accurate. So, that's one thing. That's why I'm sitting in this. It's one of the reasons I'm sitting in this ETF seat now. But there's also another really subtle aspect of this conversation, which is, okay, even if assets are normally distributed, how are we risk profiling people? What's the methodology? And when we do it, do we properly map their asymmetric preferences into a purely risk aversion framework? And I would challenge that most of the time that is not properly done. So even if assets, even if you want to stick with the mean variance framework, you still have to be really incredibly thoughtful on how you're measuring the risk preferences given behavioral biases that are asymmetric, and make sure you kind of jury rig it into this mean variance thing properly. And I would say most of the time that's not done well. So there's kind of multiple levels on why we kind of want to progress forward.
So you in that instance, then you're saying basically we could use MPT probably, or mean variance, as long as we're able to map correctly the behavioral preference of the investor, essentially.
Spot on, right? So think about it. If someone, and we're probably going to talk about this more later, but if someone has a lot of loss aversion, you can approximate their utility function with just a more risk averse utility function. If someone's really scared of the left tail, you can symmetrically alter their utility function that'll be a decent approximation to one that has more of like a left squish down from loss aversion. So it's so yeah, I mean it's definitely doable, but of course the assets have to be normally distributed. Once that goes out the door, which is, if you look at, our simplified products, our goal is definitely to have a lot more positive skew than pretty much any other equity product out there. Then all bets are off. And if you think about it, a company like Riskalyze, they publish, everyone knows them for having this like risk score.
Yeah.
But actually, I think if you dig into what they do, they actually measure the whole utility function. And they do have asymmetric things in there, but they kind of hide it and they just show one number. And so actually, I think a firm like Riskalyze is one of the few doing it really well in terms of jury rigging, behavioral biases, getting it into the MPT framework.
Okay.
But they don't expose the underlying behavioral aspects. But that's a whole nother conversation. I believe that's a really interesting thing to do, actually. So far with my book and the software, people seem to really appreciate seeing all the subtle details in their profile, like how much loss aversion do I have? Does it agree with my day-to-day life? I think they like seeing the details. So I think that's a trend that can probably pick up.
Yeah. So the going off the mean variance framework, the utility function, you're adding in not only risk aversion everybody knows of, and that's how currently the state of the investment management field kind of maps out the utility curve for the client. But in your instance, and the way you frame it in the book, is you're adding two other kind of risk preferences, right? Loss aversion and reflection. Could you maybe just touch on those two real quick?
Yeah, sure. And it's a really complicated subject. You go on
we could
forever
talk
about
hours
it.
for that.
Yeah. Sure. But the idea is that what behavioral biases matter in portfolio selection, right? So you'll see like different biases like the endowment bias or anchor bias or whatever, but what we're trying to do here is condense this down into actually valuable from like a strategic asset allocation perspective.
Sure.
And so that's how you really boil it down to loss aversion and reflection as the two new dimensions to bring in on top of the risk aversion. And so, so starting from the top, risk aversion is the sort of, created in the early 1900s, robot, rational approximation. That's all about a preference to volatility.
Yep.
Effectively, right?
Yep.
So if you don't like a roller coaster, then you shouldn't invest in highly volatile things. But then we found out with prospect theory in the 70s that people also have a couple other important biases. So loss aversion is an asymmetric one. And basically it tells you how much more people dislike losses than gains. So very asymmetric. And if you think about it, if you don't diagnose that right, in theory, someone can have very low risk aversion, but they can have very high, loss aversion at the same time. Mm-hmm. And so if somehow in your diagnosis process, if you miss that, then you can have a portfolio that's way off from where it would be. And in the book, in the software, we're talking about, allocating 70% to equities versus allocating 20% to equities. Yep. It can be way off.
Yep.
And so, that's deeply interesting from serving clients well, and also from a fiduciary standpoint. So you start to, when you really think about it, want the diagnostics of these things to be much more medical, right? Like you want things to improve towards a more scientific medical direction to like diagnose people right and then give them the right medicine. Anyway, so then there's reflection. Yep. Reflection is even stranger. It's the harder one to wrap your head around, but it's where all of a sudden people start to prefer risk when there's a possibility of losing your money. The easiest way for me to think about this is when someone is down 30, 40% on a position,
Yep.
and they hold it to get back to even,
Right.
kind of a thing. That's kind of a good encapsulation of it.
Yeah.
And yeah, that's the two in a
that's
nutshell.
great. So what you're trying to do is take in those three parameters then, right? You got risk aversion, loss aversion, and reflection, and you're building out a utility curve for the client essentially, and saying, based on this, and then we're going to jump into the second part of it, and then, but essentially that's going to be the building block as to how you get to the portfolio, right? And loss aversion, I always like to tell the story that my wife gave me like $100 Macy's gift card for Thanksgiving or something like 2 or 3 years ago, and I didn't really think about it. And then I went to Macy's to go get a tie, and I couldn't find the card, and I literally tore the house apart, tore my car apart, trying to find this $100 gift certificate that my wife gave me, which I didn't think anything of when she gave it to me, right? But now I'm like, there's $100 bill, just floating out there somewhere, and I'm totally rack nervous about asking my wife about it, right? Because she's not gonna be happy that I lost $100, right?
Yeah.
But that's kind of loss aversion in a shell, right? Like, I think the notion and prospect theory is almost 2 to 1, right? You have 2 times the pain to 1 times the gain.
Yeah, that's like a cross-sectional average.
Yeah, right.
But
everybody's different. That's what you're trying to map out, basically in the software, correct?
That's exactly right. So the book lays out a simple lottery style questionnaire that can help diagnose it. And one of the great things about that is that it seems to just, people love measuring themselves, and then they just get to think about, okay, if they really understand what it is, does this agree with sort of the rest of my lifestyle? And I think I've told this story before publicly, and I'll repeat it. I didn't understand my own loss aversion earlier in my career, and I was like doing some really highly leveraged trading, and I was stressed, and I wasn't built for the models and systems I was trading. And so it's almost like a personality test. Like, it informs you of like the kinds of jobs you should have. And so it's really exciting to learn about yourself behaviorally in like a diagnostic way, and then just see how it has affected your life historically, currently, and maybe how to like use it to kind of best create the life for yourself going forward. So it doesn't just apply to investment portfolios.
You even give I think the nod in the book, saying about like it can help inform life insurance purchasing, even all the way down to like what type of case you have on your phone. Right. So now that we built this kind of utility function, you take it another step further, right? And you talk about SLR, which is standard of living risk. Could you kind of put some color on what that is and how that's going to adjust the utility function that we built out based on this questionnaire currently?
Yeah, sure. So when you think about building a portfolio systematically, it starts by diagnosing a client's risk preferences, but then the next question is their risk capacity. And how does their financial situation, how do their financial goals affect the portfolio? What's the right portfolio for them? So, from a glide path perspective, I think we're all used to the idea that when we get towards retirement, we should be mostly in bonds, so the volatility is low, and that, all of our upcoming liabilities are met with certainty. Right. And so this standard of living risk metric is really just basically meant to give people a glide path that's personal to them. That's how you want to think of it. So just instead of just being an age, the SLR, it takes in all of your expected assets and liabilities for the rest of time, and it condenses it into this standard of living risk measure that tells you how well positioned you are for your assets and all your expected assets to meet all your expected liabilities. So in many ways, it's like a funding ratio in sort of pension land.
And ALM, I think they call it, right? Asset liability management.
Yeah, exactly.
Yep.
So But I think what's a bit novel in the book is that I'm applying this in a very systematic way. So as you alluded to, you take the parameters of the risk profile and then you moderate them based on the SLR.
Right.
So if your standard of living risk is really high, but you have but you have preferences to take on a lot of risk, we'll actually moderate that down where you'll take less risk.
To give them a better chance of hitting that goal, correct?
To give them certainty of
sure.
hitting the goal. So the idea is that if your SLR is very high, you should be invested in completely risk-free things. We have a deterministic path to get you to your goal, and you'll like just meet your goal.
Yep.
And then if you have excess assets, right, a lot of what we call in the book discretionary wealth, then you can take on more risk and you can kind of get that sort of Monte Carlo cloud where, you know, you can kind of hope for more growth, but you're still gonna, you know, not have any
shortfall.
Yeah, you're not gonna miss out on your goals. So the book is a bit draconian, and the software is a bit draconian in the sense that the system is designed to ensure you meet your goal and not have like a 70% chance of meeting your goal.
Which is what a lot of the Monte Carlo systems are based off of, right?
Yeah, in those systems, since it's not systematic, you run the Monte Carlo and then you just kind of see where everyone's comfortable with, the client, the advisor, in terms of, okay, there's a 15% chance that you have nothing, or you know, in 10 years or whatever it is, right? Depends on the cloud. But of course, you know, look, to be fair, you can update things as time goes on. So if you don't have a great 5 years, you can become more conservative. But so, you know, it's a different approach. And then the other really interesting thing is, you know, since now we're talking about two dimensions that are behavioral biases, when SLR is high, when your balance sheet isn't in great shape, we will moderate the behavioral biases away because they're suboptimal. Ultimately,
they're holding you back, essentially.
Right, they're holding you back. They're like a suboptimal thing that's not really ideal.
Right.
And so that's really interesting, right? And I cued a lot of that sort of design based off of work by Michael Pompian and a lot of his behavioral books. And so it agrees with sort of how he treats biases and how he moderates them and stuff.
Yeah, that's I think that's well laid out, well thought out. And then so now we have this kind of we've come to almost a halfway point, in my opinion, right? And now, or maybe 3/4 of the way, and now we have to build out the portfolio, right? And so could you, I know, you know, I'd like to kind of touch on stationary. You can say it better than I can. English is
stationarity. Yeah.
And then what was a historical data, right? In trying to pick assets to put in the portfolio. So could you just touch on that briefly, and then jump into, you know, how we're just gonna put those two things together to map the portfolio to the individual clients' output that we've come out with at this point.
Yeah. So I guess the next thing you really do is focus on asset selection. So what assets make it into the portfolio? And, you know, we want to get rid of assets that aren't overly valuable, you know, versus other assets. You know, we don't want a lot of redundancy. A, it wastes everyone's time. But B, when you have redundant assets in an optimizer, you know, since one of the goals here is we're trying to allow advisors to literally push go on an optimizer in their own home or office and trust the result.
Yep.
We have to remove very redundant assets, or else the optimizer will give wild results. So those are the two reasons we really focus on that. So we spend a lot of time in the book on that. And then after that, now we're at the point where we're focused on the forecasting.
Okay.
Right. So we have some minimal set of assets, and we're very focused on how to forecast returns. Now, since we're not doing mean variance optimization, now we're doing what's called returns-based optimization, because we have to account for higher moments than just volatility, since we care about very asymmetric. So we need like third moment, fourth moment, et cetera. Since we're focused on that, all we actually need to do, we're not forecasting the mean return or the standard deviation. We're actually forecasting the full return distribution. And the way we do it is we just forecast. Basically what we do is, the only really easy way to do it is you take a very long history of monthly returns, and you can kind of tweak that at the margins. But for the most part, for a strategic portfolio that's investing for the next 10 plus years, we're going to forecast by using that historical return distribution for every asset in the portfolio. And it includes all co-movements and higher moments and higher co-moments. And so that's kind of that's the, you have to leverage the historical data to be able to do this returns-based optimization that just requires so much data. But
go ahead. I was going to say, so you have to exclude. I guess first the premise is you were looking for assets that have a fundamental, alpha generation or some type of return, right? I think alternative risk premia, and then you had the traditional risk premia, and then you had geographic risk premia, right? Assets that in general should continue to provide some type of premium above the risk-free rate, right? But that then excludes a lot of, to your point, a lot of redundant assets, like MBS investing, or I don't know, bank loans or whatever it is, because you're picking up a lot of those commonalities, the co-movements and skew and all that stuff in the assets that you've kind of screened everything down to. Is that correct?
Yeah, that's right. And then, on top of it, this is the first asset allocation book I've ever seen that really, constantly shows error bars and estimation error.
Yeah.
And once you dig into the reality of that, then you quickly realize that differences in returns between a bunch of different, very similar styles of equity investing or credit investing, whatever, you can't distinguish them from an error bar perspective. So, that's another important, reason why you want to just kind of clearly identify risk premia that you believe that behaviorally will exist forever, right? People are always going to be paid to take on risk, equity risk, duration risk, et cetera. And so the safe bet is really to identify those. And, so in many ways, what the book tries to do is it tries to isolate what those risk premia are and allows you to do asset selection based on that, rather than using a lot of the multi-moment models earlier on, the moment contribution stuff. You can one-off do the asset selection, but if you think about what you're really trying to get is earn different diversified risk premia, there's a pretty obvious set that we can all start with.
Yeah, and you get into kind of, performance assets, I think, and diversifying assets, right? And that's how you're going to build out the model. So I've got my utility function, I've got my asset list, and then in my head, what I think is happening is you're taking the utility function combined with the SLR score, right? And then saying, based on these two items, this is the optimal portfolio based on its historical mean, average return, and distribution. Am I saying that correctly?
Yeah. So let me rephrase it just a little bit. We start with the risk profile. We moderate the parameters a little bit based off of your SLR. So now we have a final utility function. We have some set of assets that we're interested in. We have a set of monthly returns for those assets that we can tweak, right? The book offers ways to, if you have a secular view on a space, like maybe bonds today, and you don't think the next 50, 10, 20 years is going to look like the last 50 for bonds, which is a pretty consensus view, obviously, right now. You can shift the return distribution. You can make it the middle of the distribution a little lower in mean return. There's also ways to modify the volatility, which is more for capital gains taxes, to be honest. But once you've done any modifications you have to the historical data based on how you invest, active managers with fees, whatever.
Yeah.
Then you're ready to do return-based optimization. And there all you need is that return stream and the utility function. And they just get smashed together. Computer does its thing. And then you get your optimal portfolios accounting for all moments and co-moments.
Perfect. That's a little bit more high level than what I could do. I would imagine most wealth advisors aren't data scientists, so it's a good thing that you've actually put the software together, right? Off of the book. Give us a little information about the software package, the website, who you're working with, how you built it out, what blood, sweat, and tears went into that thing.
Yeah, no, look, I didn't want to write a book that didn't empower, right? The whole mission of the book was to empower advisors to do something very systematically on their own, right?
Yeah.
So I wanted to bring I wanted to have every advisor to have their own PhD quant guy. And so I didn't want to write a book without the software. So I built it on my own. Have one other partner that's helped build some of the HTML stuff on the front end, but yeah, homegrown and very lean software meant to just help execute on the book. And at this point, there's sort of minimal sort of like bells and whistles on it. One thing that is really cool, I think, about it is that it does enable advisors to track their clients' preferences over time.
Okay.
And so I think that's a deeply interesting and powerful thing for advisors managing their clients. People's preferences change in time based off of market scenarios, life scenarios, and it's really helpful to monitor that and really get a sense of what the person's baseline is outside of the extraordinary times.
Yep.
And it's a great way to manage your clients.
So where can advisors go to look at the software? What's the website, David?
Portfoliodesigner.com.
Perfect.
Yep, we're trying to help people design portfolios from scratch. So that's the name.
It's a very intuitive website address. So props to you for catching that. I'm surprised nobody has that website out there yet. But
yeah.
That kind of takes me into one last kind of set of questions. I've always been intrigued about behavioral finance and stuff like that. How is it that you came up with the questions that you're asking, both in the book and specifically in the software, to determine this utility function on the front end, like the first step, basically?
Yeah, so I spent a lot of time analyzing the academic literature on measuring prospect theory preferences, and after a lot of work, I had to make a decision on what was just the best, most systematic, seemingly most accurate way to do it. And these lottery style questions, I found good ways to measure each way with these lottery style questions. I found them to be very accurate. So just triangulated on this style.
Sure.
And so just but the academic literature really has a good amount on it. Surprisingly, maybe not as much as you would think.
Yeah.
But I still feel good about where it is. But still doing a lot of work on it. Recently did a big survey with a few hundred people, and there's a lot of data that we're digging through now to analyze that and compare our survey results to some of the more standard ones. And so stay tuned there. But I think this is still early innings for a lot of this risk preference diagnostic stuff.
So you're gonna evolve it as time goes on. You learn more and stuff like that. Yeah, that's
great.
Yeah,
that's right.
Well, I got just a couple more questions for you, David. I'll let you get back to the snow or whatever you guys have out there. Something I always ask the people we have on the podcast is, can you talk about maybe a mentor that you might have had, or a book you read, or a theory that you kind of follow that kind of colors or kind of frames the way you think about investing in general?
Yeah, good question. I think my answer is pretty straightforward. the first class I ever took at MIT in finance was with this guy named Mark Kritzman.
Yeah.
And I don't know if you've read any of his work, but
I've heard of the name. I have not. I don't think I've read anything he's come out with.
Yeah. He's really actually one of the most prolific writers in the space of like portfolio management.
Okay.
In like the wealth management context. He has a recent book out that I think is phenomenal, that has incredibly valuable tidbits for advisors. I highly recommend it. Practitioner's Guide to Asset Allocation. It's a widely titled, also on Amazon. But Mark's approach is to find the most important problems to solve in portfolios and to simplify it, and that's what resonated with me, and inspired me, is that there was someone with incredible quantitative mathematical chops that was using quant tools to improve and simplify. And so I just always deeply loved his ability to focus on what matters,
mm-hmm.
and not get into all the stuff that doesn't matter, and then to take those things that matter and simplify it. Super inspiring to me. So I would highly recommend checking out his book. And he has a little think tank in Boston called State Street Associates, which I think is great. A couple guys there, David Turkington, Will Kinlaw, co-authors on that practitioner book. They are phenomenal team, and always asking the right questions.
That's great. And one last question for you. Currently, is there anything you're reading or watching or following on podcasts or anything that kind of grabs your attention?
Just following markets, really, man.
Yeah.
Just really focus on markets. I think we're living in a phenomenal time, and there's the possibilities of extreme things in the market. I think is what's really catching my attention. I think extreme equity moves, extreme inflation. I think what we're seeing in technology, with some names out there really just dominating and disrupting.
Yeah.
So I just think extreme market moves and real disruption, I think, are just so interesting and exciting, and that's so I'm hyper focused on. Simplifies too. So
yeah, that's great. Well, David, I want to thank you for your time today. Again, the book is Modern Asset Allocation for Wealth Management. Thanks so much for the time and answering the questions. And feel free to. The website again was, can you say
portfoliodesigner.com.
Perfect. Well, that's it today. Thanks.
Thank you,
This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting professionals before engaging in any transaction. Securities and investment advisory services offered through Woodbury Financial Services, member FINRA SIPC. Woodbury Financial is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Woodbury Financial. Past performance is not a guarantee of future results. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Views expressed are as of the date of the recording based on the information available at that time, and may change based on market and other conditions. Although certain information has been obtained from sources believed to be reliable, we do not guarantee its accuracy, completeness, or fairness. We have relied upon and assumed without independent verification the accuracy and completeness of all information available from public sources. Investing involves risk. Loss, including loss of principal, may occur. No investment strategy can guarantee positive results. Investors should be aware that investing based upon strategies or models does not assure a profit or guarantee against loss. Krishna Patel, CFA, is an investment advisor representative of Woodbury Financial and can be reached at 317-489-3505 or kpatel@engagefingroup.com and located at 11622 North Michigan Road, Zionsville, Indiana 46077.